Camden Wealth Research, in partnership with UBS, has today launched its Global Report on Family Offices. The Global Family Office Report 2016 surveyed principals and executives from more than 242 offices internationally. Their average assets under management exceeded $759 million US. Impact investing has come of age, primarily driven by engagement by the millennial generation. With over 61% of the family offices this year indicating that they are either actively engaged or contemplating engagement with impact investing within their family offices. The catalyst for this engagement and development has been driven by the millennial generation. Findings from the Global Family Office Report 2016 clearly indicate that philanthropy continues to play an important role within the family office. More than 1/3 of the families interviewed clearly indicated that they would be increasing their allocations this year, while 2/3 indicated that they would be maintaining or holding their existing allocations. Education continues to be the primary beneficiary of family philanthropy. We have found that some of the wider social considerations of impact investing are also influencing traditional investing. Family office executives are increasingly telling us that the next generation's social values are causing them to reconsider their asset allocations. Succession is a looming challenge for all family offices. The report found that 39% of family offices are expecting a generational transition within the next decade. More than 69% of the families surveyed expect a generational transition within 15 years. This is an increasingly pressing issue for all families. Worryingly though, the report also identified that less than 37% of the next generation within the family office is either looking for or wishes to become more involved than it presently is. In our experience, the risk of disruption from a generational transition should not be underestimated. It is the number one reason for beneficial owners to make changes to either their family structure or the management team.
So when it comes to investments, and perhaps if we start with investment performance, what we found was that the average family office portfolio produced a return of positive 0.3% in 2015, the last calendar year. And that compares with 8.5% in 2013 and 6.1% in 2014. Those returns are a reflection of underlying asset class weaknesses, with the two bright spots being private equity and real estate. Looking across the different regions, there wasn't a great deal of variation in performance, albeit that Europe came out tops, followed by North America, Asia Pacific, and finally emerging markets. So moving to how portfolios have changed in the last 12 months. And on a like-for-like basis, what we found was that there was a significant move into private equity, and that's part of a multi-year trend that we've observed in the Global Family Office Report series. We also found a decrease in hedge fund holdings. And when we explored further about future intentions amongst family offices, we found that those switching patterns are likely to continue going forward. So an increase in private equity, a decrease in hedge funds. Both of those moves are driven by asset class specific considerations, as well as evolving changes to investment strategies amongst family offices. We also looked at changes within private equity holdings, and again on a like-for-like basis, what we found was that more money was moving to private equity funds, and that is specific to the smaller family offices that don't have the resources or reach to invest in private equity directly and are choosing to go the indirect route.